Good evening and welcome to today's webinar on NHS pensions and the taxation impact of the pay award. My name is Graham Crossley. I'm a director at MediFintech and I'm joined this evening by my technical director, Jack Needham. If you do need to get in touch with us, then please do send an email via admin@medifintech.co.uk. I can see we have quite a few people having joined us today. We had a capacity of 1,000 and was overwhelmed with the amount of people that have actually signed up to watch today's webinar. So for those of you who aren't aware of who we are NHS pension specialists with an excellent reputation and unrivaled technical knowledge of NHS pensions, and we support hundreds of accountants and financial advisors that work in the healthcare sector, as well as supporting members directly. And we've helped thousands of healthcare workers with their NHS pension records, and we've saved millions of pounds by identifying and correcting errors with members' pension records and annual allowance charges and backdated pay awards, which is why I'm very proud that after 5 years, we have got over 300 reviews on Trustpilot with a 5-star rating. Now, part of the work that we do is when it comes to pension support, we provide this analysis where we will analyze your pension record and check for errors and then show you and help you how to correct them. We will then tailor projections based on various factors, including early retirement, late retirement, partial retirement. We can always show the impact of annual allowance scheme pays as well as the McCloud Remedy, and we can cover flexible scenarios. So anything such as backdated pay awards, salary sacrifice lease cars, taking on management responsibilities, as well as individual support where we have a one-to-one online call with an NHS pension specialist who will explain your projection in detail and answer any questions that you may have. You can also bring along your financial advisor and accountant if you wanted to as well. So if you do want to take advantage of that service, then please do sign up and register. Now, the analysis that we've had of our existing clients has shown us that we could see a resurgence of annual allowance tax charges for 2024-25, and the recent pay award could now see multiple tax traps impacting both ends of the consultant spectrum. But there's this huge risk of sleepwalking towards a tax charge that you won't find out about until October 2025, when it's too late to do anything. The tax year will have already passed. Now, fortunately, these tax traps are gaining press attention. We've seen recent articles in HSJ and iNews. We've also seen good support from the unions trying to get this on a government agenda as well. So we've seen comments from HCSA, BMA, as well as MIP. And that brings us to this evening and tonight's webinar. So what we're going to do is we're going to sort of talk through the 24-25 pay award as well as the consultant pay deal. We're going to look at some of the potential issues that you might have with backdated pay rises before going on to cover the 60% tax trap and the childcare cliff edge, then on to annual allowance and the taper trap, before moving on to a little bit about the McCloud Remedy, and then if we have time, a Q&A session. We had intended this to be a 30-minute webinar, but we had masses and masses of questions in advance that were great questions, so we have included those within the body of the presentation. One of the questions we did have was, it's their wedding anniversary tonight, are we going to record this? So I hope you're not on this webinar this evening. Yes, we are recording it, and you should be able to see this on our YouTube channel shortly. So let's get started with the pay award and the consultant pay deal. So we saw not so long ago that consultant salary is going to be increased by 6%, and this is going to be backdated to the 1st of April 2024. On top of that, we also have the consultant pay deal, whereby we've seen this increase in pay. The number of pay points have been reduced, and there's been a reduction of 5 years to reach the top pay scale. Importantly, it's also been backdated to March, which is outside of this tax year. Overall, when you combine the annual progression through the consultant pay scale, the pay deal, and also the DDRB pay award, we could see some significant increases in pensionable pay, particularly if you're going from year 13 to 14, you could see an increase in pensionable pay of just under £27,000. If you do anything additional, such as on-call payments, that could be significantly more too. Now, on this backdated pay issue, that's first of all, let's look at HMRC's view. So HMRC have a specific section within their tax manual whereby they have said that pay rises cannot be backdated for pension input purposes. Now, unfortunately, HMRC's own example, it excludes that arrears payment can actually be pensionable in a final salary calculation, and the NHS pension scheme doesn't work that way. It doesn't separate the 95 and 2015 scheme. If you have pensionable pay, it applies to both schemes. So you accrue benefits under the career average revalued earnings scheme, so earnings divided by 54, and in the final salary scheme, that extra pensionable pay is used against your service. So there's a risk that you could have this artificial pay spike. Now, NHS pensions, however, they do have guidance when it comes to backdated awards. So they have stated that NHS employers are instructed to ensure that backdated pensionable pay is allocated to the correct year. Now, at MediFintech, we've got lots of experience of this. We've saved people millions of pounds by identifying, for example, clinical excellence awards that were paid late, incorrect on-calls that were paid at the wrong time, as well as missed increments, and getting those backdated to the right pension years. And by doing that, you avoid these artificial pay spikes with the tax charges. And we have recently double-checked with NHS BSA and their technical team, would this apply here? And they have said, yes, NHS employers are instructed to ensure that backdated pensionable pay is allocated to the correct pension year. So what's the impact of backdated pay rise? Well, if that arrears payment was pensionable and it creates this artificial pay spike, then there's a positive impact if you have a very near future pension award, such as standard retirement or even ill health retirement. However, this could get caught up as being misallocated. But there is also this potential negative impact, and this could be significant because if that arrears payment is pensionable, it creates this artificial pay spike, which could lead to annual allowance tax charges that you wouldn't have had otherwise. So let's have a look at that in a bit more detail, because that arrears payment has the effect of bringing forward future pension growth from a year that might not have been subject to annual allowance tax charges to a year where tax charges could apply. So the biggest 1 month arrears payment is £1,124. So once you take away the pension contribution, higher rate tax, the loss of personal allowance, and also national insurance, your net take home is £373. However, that additional pensionable pay has increased your pension, and that has given rise to an annual allowance tax charge of £3,154. So in this case, additional pay, that arrears payment would actually mean you'd actually get less pay, because if those pensionable pay arrears were allocated to an earlier year, it could use historical annual allowance, it could use historic carry forward, plus it reduces that overall pension growth in the current tax year as well. Now, the implementation of this backdated pay rise has been a bit of a lottery. So some employers have amended pension records to put pensionable pay arrears back in 23-24. Some have left them in the 24-25. And that's not surprising. We already have seen that with clinical excellence awards. We've seen it with on-call payments. We've seen it with increments that were missed. But what this is going to cause is additional administration. So employers or members or experts like MediFintech, for example, we will be analysing records and we'll be able to identify where those misallocated arrears are and correct them. And this could be a potential headache for NHS BSA, because once those, if this is after statements have been produced, well, they're going to have to recalculate the annual allowance for those years and then send out new statements. But correcting these misallocated arrears could save you thousands of pounds. So please do keep an eye out on your own pension record that this has been done properly. So moving on to the 60% tax trap, or the 67.5% tax trap in Scotland. So this goes back to the budget 2009, whereby Alistair Darling introduced a reduction in personal allowance for those earning over £100,000 from April 2010. Now, when it comes to these types of tax issues, there's this thing called fiscal drag, whereby when those tax thresholds do not increase, it drags more and more people into these higher tax brackets and exposes them to greater tax. that £100,000 threshold has remained unchanged since April 2010. If it had increased by CPI, it would now be 149,663. Now, if you are in the 60% tax trap, then your personal allowance is reduced by £1 for every £2 that your adjusted net income is above £100,000. And there's a full elimination of your allowance once your taxable income has gone over £125,140. So once you're in that tax trap, for every pound that you earn, 2p goes off for national insurance, 20p goes off for loss of personal allowance, and 40p goes off for income tax. So you're only taking home 38p. Now, to compare that to an additional rate taxpayer who's earning more, well, they would take 53p for every £1 that is earned. So this 60% tax trap, if you're doing extra work, you're going to have to question the real value. Is it worth your time doing that additional work? But more importantly, we saw in the budget for 2024 an extension of the 30 free hours scheme when it comes to childcare of preschool children. But they also have this limit whereby if any parent earns more than £100,000, then they will lose parts of that childcare support. Now, Institute of Fiscal Studies, the IFS, they warned that this is absurd, that distortions that the cliff edge will create are among the most severe you will ever see within a tax and benefit system. They create this great graph where it shows how there's this huge incentive to keep your taxable income below 100,000. I want to draw your attention to the bit that's highlighted in red. You can be better off earning £99,999 than you would do earning between 100,000 and 144,000 if you were living in London with a couple of children and needed 50 hours of childcare. There's a great thread that Dan Needle has kindly let me include in tonight's webinar, whereby he was messaged by a consultant who earns just under 100,000 and wanted his trust wanted him to take on some extra work for which they're going to pay £125 an hour. But this extra pay meant that he would have this marginal rate of 62% because the national insurance as well, and he would lose the eligibility for free childcare. So he would have to work 61 hours just to make £1 of additional net income. So it didn't make sense. Following on since then, we've now had the 6% pay award, which now makes it a significant risk for all consultants with young families. So if we start off with those consultants at the beginning, so in threshold 1 and 2A, the gross income is now 105,504, 111,713. Once you look at the taxable income, so you take off the pension contributions, then they stay within higher rate tax. Their taxable income is 92,316, 97,746. They just avoid the tax trap. However, big warning here, your taxable income is income from all sources. So it includes any savings you might have, any investments that you might have, any buy-to-lets, even P11D benefits if you have like a salary sacrifice lease car, all of that would be included. Now, if you look towards the consultants who've been a consultant for longer, suddenly all of them are caught squarely in that tax trap. So if they have young children, then they could be significantly financially disadvantaged. So what's available to them? Well, those consultants who have been in sort of consultant threshold 1 and 2A, they are incentivized to avoid doing additional work. If you did one extra PA, that puts you into the tax trap. If you do on-call category A low, that's just the 3% increase to your pension pay. That puts you into a tax trap. So taking on this additional work, where's the incentive for the consultant? Again, if you look at those who have been a consultant for longer, well, they're actually incentivized to reduce work. Because for consultant thresholds 2B and 3, well, they could drop a PA in order to avoid the 60% tax trap. And those who've been there for longer in threshold 4, well, they could drop 2 PAs to get below the threshold. So some consultants with young children could work less for more income, and that's just nuts. And we've been contacted by a consultant who's been a consultant since May 2023, works 11 and a half PAs, and also does on-call as well. So young family, they rely on childcare. Before the pay award, their taxable pay for the year was going to be just under £99,000. But once the pay award hits, it takes them above that £100,000, which puts them in the tax trap. And the extra money they get, remember, they only get 38 pence out of every pound, plus they lose access to all of that childcare. So this consultant is significantly financially disadvantaged because of the pay rise. So one of the options to them would be to drop their on-call and also drop their PAs by 0.5. And that would actually put them down to £99,738 taxable income. So they would actually be better off working less hours. There are a few options in order to reduce your adjusted net income. One, the obvious one, reduce your hours. You could also do salary sacrifice, but word of warning here, because these also have knock-on consequential effects. So, for example, if you take on a lease car, well, that can give you issues with regards to annual allowance in the future when your pay comes back up again. Also, remember the P11D benefits associated with that lease car could also be added and take you over the tax trap. Other things such as cycle to work, IT equipment, etc., they can reduce your net income. Other things you can do are bizarrely pension contributions. So you can contribute to a personal pension. You can also contribute extra to the NHS pension, either via added pension or via those freestanding additional voluntary contributions. You can also gift aid, and gift aid has the benefit whereby it can also be backdated. So if you get to the end of the tax year and you've realised that you've made a mistake, there are things that can be done as long as you make those gift aid payments before you do your tax return. And one other thing that we see quite a lot, especially with newer consultants, is make sure you claim your expenses, because they can also reduce your net income. And for those who've got savings, because bearing in mind with interest rates getting higher, we are now starting to see people actually make money on their savings. If those savings are the bit that's taking you over this tax trap, well, consider moving them around so that they are in a lower taxpayer's name. Now, all of these tend to be horrendously complex, and medical finance is uniquely complex. We are not accountants at MediFintech. We work with a lot of specialist medical accountants, and I would urge you, if you're considering any of those actions, and if you don't have an accountant, then get one. And I would recommend this organisation, ASMA, which is the Association of Independent Specialist Medical Accountants. They've always keep on top of what's going on with NHS pensions and what impacts medics' finances. So definitely use a specialist medical accountant. So moving on to annual allowance. So annual allowance is the limit to the amount of contributions that can be paid to a defined contribution pension scheme, and the total amount of benefits that you can build up within a defined benefit pension scheme like the NHS for tax relief purposes. And this applies across all of the schemes that you belong to, as well as including all the contributions that you or your employer make. So if you have private practice and you contribute from your limited company, it includes all of this. And if you exceed in any one year, you can offset any unused allowances from the previous 3 tax years, but any excess is then charged at your marginal rate. Started off very large, 215,000, went up to 255, aimed very much squarely at those in the city who are trying to hide income by putting it into pensions. It was seen as a very easy target to raise additional tax revenue, so it came down to 50, then to 40. Then we started seeing additional measures whereby it could go down as low as 4. We've recently, from the spring budget 2023, seen the allowance go back up to 60,000, but it could go down to 10,000 with annual allowance taper. And I'll be covering off the annual allowance taper trap as well this evening. So the tapered annual allowance was introduced in April 16 to restrict your pension tax relief if your adjusted income was more than 150,000. It's subsequently been increased to 260,000, but for every £2 that you go over your adjusted income, your annual allowance is reduced by £1, and it can go down by 50,000 all the way down to £10,000. Now, importantly, there are 2 stages to annual allowance taper. The first one is the threshold income check, and then you have the adjusted income calculation. So for the threshold income check, tapered annual allowance only applies if your threshold income limit is more than 200,000, if you breach that. Now, To work this out, you look at your income chargeable to income tax. So that's your total gross income from all sources, including all of those investment incomes, etc. You also add back in any salary sacrifice or flexible earnings arrangements that you've set up since the 9th of July 2015. But importantly, these are only arrangements where you've given up income in exchange for employer pension contributions. There was a bit of misinformation that went out originally on this when we first started seeing annual allowance taper, and people were adding back in childcare vouchers, they were adding back in salary sacrifice lease cards and exposing themselves to taper. You don't need to. It's only those arrangements where you've given up an income in exchange for employer pension contributions. You can, however, deduct personal pension contributions, including the tax relief that's given by HMRC. If you breach threshold income, then you move on to this stage where you work out the amount of reduction. So you take your threshold income, and to that, you add your pension input amount. So that includes basically your and your employer's contributions, and that becomes your adjusted income, and your annual allowance is reduced by £1 for every £2 that your adjusted income is over 260,000, down to a minimum reduction of £10,000. So annual allowance itself is not based on your NHS pension contributions, it's based on the growth of your pension benefits, something called your pension input amount. So to work this out, you have to look at the value of those pension benefits at the end of the tax year. So you take your pension and you multiply that by 16, and then you add the lump sum. You then, from that, take away the opening value of your pension benefits. So again, that's at the start of the tax year now, your pension multiplied by 16, add the lump sum, but this time there is an adjustment for inflation. So you get to uplift that by 1 plus consumer price index, which is basically the September CPI before the tax year started. And you might be familiar with these. So these are on your pension savings statement. So you'll see that opening value and closing value. That's that pension times 16 plus lump sum. I can tell actually we've been doing this talk for quite a few years now. This statement's quite old, as it's from 2018-19. But you'll also see the pension input amounts on there as well. So you'll see those growth values, that closing value minus the opening value, and also the 3 years for carry forward. But whilst I mentioned carry forward, it's important to know, whilst you can use the last 3 years of unused allowances, those allowances, when it comes to calculating, you actually need to go further back beyond that and go all the way back to 2010-11. Makes sense when it comes to calculating your annual allowance, which I'll come on to for McCloud in a moment. We've now seen a more modern representation of that data as well. If you're in England and Wales, you can ask NHS pensions for your annual allowance and service and pay extract spreadsheet, which I would urge you to do at least once in your career, because as a quick tangent from the pensions tax, one thing to look at is your pension record, because one of the great things about this document is it shows you all of the work that you've undertaken within the NHS that's been pensioned. So it has start date, end date, pensionable pay. If you're on a less than full-time contract, it has how many hours you worked, as well as what the standard hours were for that contract. And if you have got service that's missing, it's definitely worth making sure that that gets corrected. So going back to annual allowance and NHS pension taxation, we've seen some absolute game changers in the last few years. The first one was the end of CPI disconnect. So historically, there was this CPI disconnect whereby your benefits were revalued using CPI after the start of the tax year, but those annual allowance calculations, that pension times 16 plus lump sum, they were uplifted by CPI before the tax year started. So in some years, you could be charged for inflation. But fortunately, Department of Health have stepped in and they have changed the revaluation date to the 6th of April. Seems like a small change, but it does now mean that both the same rates of CPI are used at both parts of the calculation. So this could significantly reduce annual allowance issues for members going forward. The next one is combined pension input amounts and negative growth. So this was put into place earlier this year. So it actually got put into law from the 6th of April of this year. But what it means is that any negative growth that you have from the 1995-2008 scheme can now be offset against the 2015 scheme. Now, what I mean by negative growth is if wage inflation is less than inflation as measured by CPI, then those final salary schemes, in real terms, your pension value has gone down. Now, historically, that negative growth value was simply set to zero. So even though your combined growth could have been less than the annual allowance threshold, you could still have had a tax charge. But you can now offset that against the growth you have in the 2015 scheme. As I say, it came into force this year and it applies from the 2023-24 tax year. And you know those extract spreadsheets I was just talking about, some of you, if you look at them now, you might actually already start seeing some of those negative values on there already. So that's going to be very, very useful along with that CPI disconnect fix when it comes to annual allowance tax charges. But could we see the return of annual allowance tax charges for 2024-25? Because we've had people going through increments, the pay deal, the pay award. This will create annual allowance breaches for some in 2024-25. So I've mapped out the different pays based on how many years you've been a consultant. There's been an assumption of how many years you have in the 95 section. For anyone who watched our webinar on the consultant pay deal earlier the year, you'd have seen this, and we did an analysis based on 5% DDRB and then a range of sort of 1% up to 10%. So this is now factoring in the DDRB at 6%, as well as the pay arrears as well. So the actual figures for you will depend very much on your circumstances. So for example, how many years you've built up in the 95 section, if you've got an added years contract, all of those types of things will have an impact. But that growth will be artificially higher if that pensionable pay arrears payment, so that March payment, if it's not been allocated back to 2023-24. Members who've got on-call responsibilities, because that gives you an enhancement to your pensionable pay, you're going to see slightly higher growth than this. And anyone who's got clinical excellence awards, the old style pensionable ones, whether they be local or national, you'll likely see lower growth because those CA values were frozen. Now, as far as the impact goes, I would say don't panic, don't throw your pension out with all of this, because overall, the pension benefits outweigh the tax costs. Because if you look here, we've had this consolidation of all of the pay hitting in this 1 year to try and tackle some of that pay erosion. And in doing so, your pension benefits escalate all within 1 year. So here we see that the pension has gone up by £11,919 and the lump sum by £26,934. And of course, that's then triggered huge growth values. And we can see that there's been an annual allowance tax charge of £24,723. This does not mean to come out of the pension scheme, because you can, for example, use scheme pays is not the ideal type of solution. Ideally, this could have been spread over a longer period of time, but it would only reduce your pension by 1,187 and the lump sum by 2,500. So overall, this is also factoring in taking in 2015 benefits 7 years early. The pension is still going up by just under 10,000 and the lump sum 24,387. So those pension benefits can outweigh the tax cost. However, there is one cohort that has to be really worried about this, because we saw annual allowance tax taper cause huge issues in 2019-20, where we had the nonsense whereby £1 worth of additional pay could, over 110,000, could trigger a £13,500 tax bill. And they tried to address this by chucking these thresholds much, much higher to 200,000. But because we've now had this higher than usual growth in 2024-25, which has been caused by the pay award and the pay deal, as we saw there, a consultant going from years 13 to 14, 160, 170, if you've got on call, even higher, just £1 over that £200,000 of taxable income could trigger a £22,500 tax bill, which is nuts. This is going to be high earners, so it's going to be people with senior management responsibilities, people who are doing many PAs over the standard 10 sessions. So it's people that they're going to be looking to try and help get rid of these waiting list initiatives. But this is a huge barrier, because it basically means for one cohort, you're going to be paying to go to work. Now, I just wanted to quickly cover off the McCloud Remedy, because this also has an impact on annual allowance for this year and also has an impact on those tax traps. So as a brief reminder, as the timeline on McCloud, we had Part 1. So that was the bit that dealt with the removing of that sort of transitional protection. So from April 2022, all continuing pension accrual is in the 2015 scheme for everybody. You still benefit from final salary linking. So your years that you built up in the 9508 scheme will benefit from your pensionable pay as it increases throughout your career. But we're now starting to see McCloud Remedy Part 2 happen. So the first part of that was the rollback. So this was on the 1st of October last year, whereby everybody was returned to the pension scheme from whence they came. So if you were in the 95 scheme from before, you would go back to the 95 scheme for those benefits that you built up during those 7 years. Now, as you're going to be in a different pension scheme for those 7 years, your pension growth will be different for those 7 years. And so your annual allowance calculations that cover the remedy period will also need to be reviewed. And that will then also impact your carry forward that is available for the 24-25 tax year, as well as last 22-23 tax year as well. Now, there was no choice to that part. That happened to everybody. But at retirement, you will get a choice, and you'll get to decide whether or not you want your benefits in the legacy scheme, so 9508 scheme, or in the 2015 scheme. It's the type of analysis that we've been doing for people for quite some time now, whereby when we project people's benefits to their retirement age, we show people, well, this is what your benefits look like if you're in the 95 section. This is what happens if you put those 7 years in the 2015 scheme. And it will be very much dependent on individuals as to what's going to be the right choice for them. But with regards to this retrospective taxation, if there's a decreased tax liability, then the government will account for all of the remedy period. Normally under self-assessment, you can only go back for 4 years, but you can now have compensation back to 2015-16 or refunds back to 2019-20. If you have an increased tax liability, HMRC are only going to collect for 4 full years previously. So we've got these in-scope years and out-of-scope years. So in-scope being 15-16 to 18-19, and then the in-scope is going to be 19-20 to 21-22. Now, if you do have a new tax charge, you can use scheme pays. If your tax charge has reduced and you use scheme pays before, well, you can adjust those. If you have a new charge in the 2019-20 year and you're in England and Wales and you qualify, you should be able to get access to the annual allowance compensation scheme as well. Unfortunately, this annual allowance exercise is not reassessed again when you take your final choice at retirement. Now, just to sort of give you an idea, so we've done the modelling on this for many, many members now, but if you look at the pension growth that we have for a consultant, you can see before the 2015 scheme is introduced, the pension growth in the 95 section. It still grows after then because of that final salary linking, but you also see the growth that kicks in from the 2015 scheme. When you overlay the annual allowance, well, you see breaches and you see tax charges. And this member is charged over £16,000. But when you roll this back and then replay it as though it was only in the 95 section, the pension growth is a little bit lower, which has an impact on annual allowance taper there. So you get more annual allowance, and this member would receive compensation of £16,000. The other important thing about McCloud is contingent decisions, and this will also have a bearing on this current tax year as well, because any actions that you take to change the past will impact the present. So we saw when the 2015 scheme was introduced, people opted out, gave up added years, and also hokey-cokeyed, where they left the scheme for a bit, rejoined, left the scheme for a bit, rejoined, all to try and sort of control that annual allowance growth mechanism. Now, members will be able to reinstate NHS pension, and you don't have to reinstate all of it. You can select which bits you want to reinstate, and timing will be the only evidence that's needed. So that's from October 2014 up until April 2022. Now, you would need to pay contributions. They'd need to be paid retrospectively with interest. We're still waiting for the final details on this. It would be very interesting if you can use an employee contribution on a contingent decision to get you back below the annual allowance taper trap. But again, that's something we'll be looking at when the details are announced. Now, there will be some supporting information that you get. You're going to be getting these remedy period pension savings statements that will include that pension growth, and they're going to be issued by the 6th of October 2024, and the statement will be based on the 7 years of remedy period as well as the previous 5 for those carry forward calculations, and also the 22-23 tax year. Now, once you get that information, you're going to have to process it through the HMRC calculator. This digital service is actually currently offline as they build in some enhancement. There's meant to be a release in the middle or end of September. But who's going to pay to fix all of that? Well, the scheme can compensate for this, for any direct financial losses associated with that discrimination. And so you can claim up to £1,000, including VAT, for that rollback reassessment, and also £500, including VAT, for the McCloud Choice support as well. We have launched a support service for this. It's still in registration at the moment, and we're hoping to launch in the next few weeks. We've got some ongoing talks with HMRC on how this process can be made significantly better for members. We've got some very positive outcomes coming from that, but we'll announce more on that in the coming weeks. But what can you actually do now about all of the annual allowance? Because you don't know what McCloud is going to do to your annual allowance position. So you don't know what your carry forward is going to be. You don't know what your pension growth is for now. Well, with regards to that taxable income and tax returns, it's important to know your numbers, and I would strongly advise you to look at your payslip, try and understand where you are on your taxable pay, where it's going to be by the end of the year. Speak to a specialist medical accountant on this one. As I mentioned, ASMA, a great organisation with lots of accountancy firms all around the country. With pension growth, it's a bit trickier. There's no easy mechanism to do this, but there are some options available. You can do it yourself. You can get a specialist medical accountant or financial advisor, or we can help. So if you want to do DIY, there is lots of information available online. The NHS BSA website is very, very good. They've just started doing a podcast as well, where they're trying to help educate members, and I'm hoping over time they'll cover more and more topics. There's also an NHS Employers Annual Allowance Ready Reckoner. The URL is on your screen now, where you can go in, put your details, and it will tell you a rough idea of what the pension growth is. Unfortunately, it's a bit out of date, as it doesn't include, for example, impact of McCloud and things like that, but it gives you a good bearing. So there are ways you can do this roughly yourself, but as with all of these things, be warned, there may be things, particularly with the complexity of NHS pensions, that you might not spot that a specialist would. So you could, for example, go to a specialist financial advisor accountant. Many of them have got tools to model your NHS pension as part of their financial planning process or accountancy services. We certainly support many accountants and advisors. So we work in the background to those companies and help them to help you. And we also have our direct service where, as I say, if you want to model what your annual allowance is likely to be as a result of pay awards, or even decisions you might make with regards to your career, well, we can model that. We can model early retirement, late retirement, partial retirement, any scenario that you can throw at us. I do want to thank you all for joining, and I appreciate this was very much a sort of cobbled together very last minute, and we are trying as much as we can to raise awareness on NHS pensions issues. If you do need support, then please do get in touch. And again, if employers want to get in touch with us, again, they can do as well. But thank you very much for attending. Thank you very much for your time. And I'll draw the evening to a close. Goodbye.